Welcome back, everybody. We're going to start things a little bit differently. I want to play a quick couple of minutes of this Peter Schiff video, and we'll use that to get rolling on our video. So here we go.
These hedge funds were out there. It was the next big short, and everybody was convinced, oh, the yuan's going to get killed. I remember saying, these guys are going to get killed on this trade. It's going to go the other way. The Chinese yuan had its biggest rise in 9 years last year. And in fact, I believe that this year, the dollar is going to hit an all-time record low. I think we're going to crack below 6-to-1 in yuan. That's never happened. We're 6.4 right now. The record low is about 6.1. But I think we're going to crack through 6, and I think that's very significant. I don't think the dollar will hit a record low against the euro or the yen this year, but it could easily do it, I think, next year in 2019. The dollar was falling in the late 1980s. From 85 to 87, the dollar got killed. Now, what happens when the dollar is going down? Interest rates are going to go up. And what is happening? The yield now on the U.S. 10-year is still low. It's about 2.63 or 4 or something like that. But it's the highest in almost 4 years. And why is this significant? See, because if the dollar is going down, right, why would anybody outside the United States want to buy a 10-year Treasury yield yielding, 2.6%? I mean, you can only do it if you hedge the currency. But if you actually look now at the cost of hedging U.S. Treasuries, it creates a negative yield. So you can't make money. The cost of putting on a hedge right now in dollars wipes out the entire yield of U.S. Treasuries. So there is no real investment demand outside the United States for Treasuries because nobody could buy a Treasury and make any money, right? Not unless they want to gamble on the dollar turning around. But why would you want to take that gamble? Especially if you look at stocks all around the world, stock markets everywhere are going up. Who is going to settle for a lousy 2.6% return and take all that currency risk? And of course, there's also interest rate risk, because if interest rates go up, bonds go down. Now, Americans aren't going to buy treasuries, one, because they're broke. They don't have any money to buy treasuries. But again, they all want to buy stocks. Who's going to want to buy a low-yielding treasury? And of course, the Federal Reserve has already basically said they're out of the treasury buying game. Right now, I don't believe them. I've never believed them. But they've been talking about the fact that they are going to unwind their balance sheet. Right now, it's about $4.5 trillion, and it hasn't shrunk at all since they've been talking about it. But everybody believes that they're going to shrink the balance sheet. Well, in order to shrink the balance sheet, that means they're a net seller of treasuries. That means the treasuries that they hold, they're going to let them mature. They're not going to roll them over. So that means the Treasury has to find an alternative, a replacement buyer for those treasuries. Well, who's going to do it? Now, China, there were already rumors like a week ago that China is finished buying dollars, that they don't want to buy them anymore either, or treasuries, which means they're going to do the same thing as the Fed. But of course, if the Central Bank of the United States doesn't want to buy any more treasuries, why should the Central Bank of China want to buy them? Right? It makes sense. Now, they came out with a rumor denying that, but I read the denial, and you know what? They really didn't deny it. So to me, where there's smoke, there's fire. Plus, why the hell would the Chinese want to buy any more treasuries? So if the Chinese aren't buying treasuries, the Japanese and the Chinese are the two biggest foreign creditors. Japanese don't look like they're buying them anymore either. So I don't think there's any real buyers. I just think there's sellers. I think that we're going to break the downtrend. This big bull market, this 30 whatever year bull market, the bond bull market started, believe it or not, probably in the early 80s. And we've had cyclical declines, but yields in general have been coming down for all that time. That's about to change. Yields are now going higher, much higher. But here's the problem. America's broke. America has more debt than ever before. The national debt is getting closer now to $21 trillion. In 2008, it was what? Not even $10 trillion when we started the financial crisis. So the debt has more than doubled since the financial crisis. Why do we have a financial crisis? Because we had too much debt. Well, now we have much more, right? And it's not just the federal debt that's gone up. American individuals are in debt more than they were back then. They have more credit card debt, they have more student loans, and they have more car loans. We don't have more mortgage debt, but that's because home ownership is at a 50, 60-year low. So you can't have a mortgage if you don't have a house. But people don't have the home equity that they had. I mean, people are broke. People are living paycheck to paycheck in the United States. So we can't withstand rising interest rates. What has really been propping up the U.S. economy is cheap money and cheap gas, right? Because oil prices collapsed, a few years ago, and that gave everybody a boost. And we've had all.
All right. So the way I see it, if there's this much debt in the economy, and not only private but public, and we know from the past that sometimes private debt becomes public debt when they bail out the banks. So you just assume that all the debt's the same. It doesn't matter public or private, but you have all this debt. So if you have all this debt in the currency, in the economic system, then there's not a lot of faith. So what I think he's saying here is that other countries and people in our country, nobody wants to invest in the dollar because we see what a failure the system is because of the outrageous amounts of debt. Like he said, we're going to break $21 trillion in U.S. debt, which is just, I mean, I doubt the founding fathers would even be able to fathom that number. And that's where we're at. I mean, that's reality. So what happens is, to attract more buyers into the dollar through the notes, the Federal Reserve has to raise the interest rates up. So they have to make the note more appealing. So why is that bad? Well, when you raise the interest rates up, you're essentially you're going to start pulling money out of the stock market, because if I can, let's say an extreme example is the Fed pushes the rate up to 6%. Well, I can maybe get a 5 or 6% return on a company, but I can get a guaranteed 6% return from the government, almost zero risk. I'm going to go into the bond and get and go after that. The other problem with the interest rate going up is any outstanding debt. So any company that's over leveraged, who basically had free money because they took a loan out at almost a 0% interest rate, if that's not a fixed loan and now the interest rates are going up, now they owe more money on what they took out originally. So now what they were managing as a debt at 2% might not be manageable at the 6%. So the rising interest rates are sort of the last domino for all this to take off. Now there's a lot of people out there that are still like bullish, like, oh, we've got 2 or 3 more years. They might be right. I mean, I don't really know that anybody can predict anything that accurately, even down to the year. But what I do know is that the debt problem is not changing direction. Where the underlying problem is only getting worse. Essentially, you're going to have this collapse happen at some point, right? So we're not paying down our debt, and hopefully, we can say, well, if we keep this up, we can avoid chaos. No, we're continuing to fall farther and farther in debt. At this point, there's almost no way out of this. And I think that's kind of what Peter Schiff was trying to get across. He's also, if nobody's ever heard of this guy, he's the guy that predicted the 2008 financial collapse. If you go back and watch some of the videos, like some of the news broadcasts from like a week or 2 weeks before the collapse, it's eerily similar to what we're hearing today. Like they saw some volatility and they said the same kind of things that they're saying on the news today. So like, buy the dips, everything's fine, don't worry about it. This guy, Peter Schiff, he got on and he was saying the exact opposite of everybody else. He's saying, look, at that point it was the subprime lending and the housing market collapse. He was warning everybody about it, and it's the same problem. It's a debt problem. And he said, look, the market's going to collapse. It's going to be one of the biggest collapses since, I think he's at 87, which was the last one. And he was right. He was dead right. So I like to listen to this guy because it seems like he was the only person that hit the nail on the head as far as the 2008 bubble. And I found another interesting chart. Let me try to find that one sec. So I saw this on Twitter, and I'll put a link to my Twitter in the bottom of the video if you want to look at it. But I thought this was really interesting. It's basically U.S. corporate debt outstanding as a percent of GDP. So they have the late 1980s boom. Then you can see the tech bubble, and I don't know if you remember. I was pretty young, but basically it was the dot-com bubble. It's also been called. So here's the tech bubble, and then here's the housing bubble, and this is what they're calling the everything bubble. I mean, I thought that was pretty interesting. It's a different way of looking at it, but yeah, I thought that was a great name for it. It's the everything bubble. So what do you do? What are you supposed to do in this situation? Like I said before, you're going to want to invest in recession-proof companies. So if you're going to continue to be in the stock market, you're going to have to accept that it's probably going to go down at some point, if not this year, then next year. But who can really predict it? But just bank on that. At some point, it's going to go down, so you can invest, but invest in things that are going to be safe and recession-proof. And one of those companies that I think would survive is Omega Healthcare Investors. So that's one stock I was going to discuss today. I can't remember if I discussed this in a previous video, but I'm just going to go through it real quick. So here's why I think it's recession-proof. One is it's a skilled nursing facility and an assisted living facility. So neither of those things go away with the recession. So you have a recession, the economy turns upside down, people are still sick, people are still old, people still need care, and it's just not something that's a luxury that you can just get rid of, like a Netflix or going to the movies or going to a baseball game. It's not a luxury, so it's definitely something that's going to be around, no matter how the economy's doing. So let's look at the financials. And I'm working on a format. I'll hopefully have it finished by next video, so it'll be a nice, clean-looking way to look at the statistics for the stock instead of this ugly calculator that I use. But all right, so here's OHI. The price to book value is 1.46, and the book value is continuously going up, which is another thing I liked. So if you can see here, this is the book value per share, and that's a nice increase. So your PE ratio is 14.91, so generally you want it under a 15, so that's good. The yield, this is what attracted me initially, is 9.77%, which is a huge dividend yield. And the 5-year average was a 6.41. So as far as a percent return, you're looking at a 6.7% return. The only thing I'd watch out for is the debt to equity ratio. But I've noticed with real estate, they tend to run at a higher debt to equity ratio than other companies. And the current ratio was a little low, again, because of that same debt issue. So the debt, in a recession, the debt might affect this company negatively, obviously, but I just don't think it would affect it to the point of insolvency. So I think you'd be all right there. This is OHI, October 6, 2008. And this was the lowest it got during the collapse, which was 925. So it lost, 50% relatively quick, which a lot of things did. But it didn't stay that low very long. And by the end of the year, by the end of 2008, it already recovered half of what it lost. And then it didn't quite get fully recovered until a year later. And then we've got our full price back. So, I mean, some companies got wiped right out. I don't remember if you remember, like Lehman Brothers and was it Bear Stearns? Some companies just got wiped off the map, but this company survived. So it survived 2008. It took a 50% loss and gained everything back within a year and a couple months. I think that's pretty recession-proof. So that was one thing I looked at. All right, so here's my Robinhood app up. Usually I start out with this, but I just want to start out with that Peter Schiff video because I thought it was pretty interesting, especially when you compare it to what else you're hearing on the news. So my total return minus $1.29 because this was one of my earlier stocks that I purchased, and it was early January when the market had hit its peak, hit its highest ever in history. So that's when I decided to start investing, which is my typical timing abilities. I have a return of minus 129. Today's return was $1.20. This is currently my third largest position is in OHI. Now looking at it more recently, they had an earnings call back on Valentine's Day, and the stock went up consistently over the next couple days. But all in all, I think it's a pretty sound company. Other than the little bit amount, the debt ratio I don't like that much. But other than that, I think it'd be a relatively safe place to continue to get a nice dividend, to a good place to put your money, recession-proof, and over the long haul, I think that this company is just going to keep going up and up in value. So that's OHI. Let's look at the rest of my portfolio real quick. I'm up for the day, $4.23, and I just tried scrolling with my mouse. What's sort of tanking me right now is my bet against the market, which is SDS. So I'm doing dollar cost averaging with this, and the idea behind it is you put X number of dollars into the stock every month or every week or whatever, and that way the idea is if the price was up that week, you're buying less shares of it, so you're buying less shares at the higher cost. If the price was down that week, you're buying more shares at the lower cost. So by putting X number of dollars each time you purchase it over time, you buy less stocks when they're expensive and you buy more when they're cheap. So that's called dollar cost. I believe that's called dollar cost average. So what I'm doing is just slowly buying it every week. And right now it's my largest position. I think eventually I want to get like 25% of my portfolio hedging against the S&P because I just don't see a viable way out of an inevitable collapse. So that's kind of my, between that and the DJP, which is the gold or the commodities ETF, those are going to be my two places to hedge against the market. All right, so 200 invested. Yes, I got that 200 invested. We're good there. Sobriety. Yes. I didn't even have time to think about drinking. I've been working a lot and I've been staying very busy. So there's another strategy you can use if you're struggling with sobriety. Is just keep yourself busy. Just take on as many projects. Try to start some, as Jeremy says over on the Financial Education channel, which I'll link to below. Start trying to create some, what's he call them? Passive revenue streams. So just try to get some, work on your income, work on getting your income, because the more money you're making, the more money you're bringing in, the more you can invest, the more you're going to save, the more you're going to make. So keep yourself busy, and then you really don't have time to drink. Did I lose 0.6 pounds? Yes, and I'm actually surprised by what I'm losing. It seems like it's going rather quickly, but I'll show you. So I'm at 222.6, and last week I was at 254.4. So that's almost 3 pounds in a week, and I don't really understand how. Maybe it's the swimming, but I was only my target for fiscal week 7 was 231.8, and I'm at the 222.6. So I'm still ahead of schedule. That goal is going really well. I'm pretty happy with that one. It seems like I just feel like I'm not putting in any effort and I'm getting results, which I don't. I guess you can contribute it to not drinking a 12-pack every night, but I just didn't expect it to go that quickly at all. So we're good on that front. And then 20 subscribers, no, and I'm just going to start putting how many subscribers I do have. So I'm up to 5. I'm very happy with that. 5 subscribers, so if you're one of those subscribers and you're listening, thank you very much. And tell your friends and family. And as always, stay sober and stay profitable. And let me know what you think, whether you disagree with me or agree with me about our debt situation and what it means for the stock market and what it means for the economy in general. If you completely disagree with me, I'd like to know, and I would love to have a discussion about that. And if you agree with me, tell me some things that you see that I didn't mention, maybe some red flags that you're noticing, and I'll include them in my video next week. But as always, stay sober, stay profitable, and I'll see you guys next week. Thank you.